Today is we're gonna go through annuities. I'm gonna go on Thursday for the product training, the Zoom training. We've got they're gonna go through American Equity, so I'm gonna touch on that from a product level. As far as a good, the volume, Trish, or no? So I'm gonna go through, I'm gonna go through their growth product, the Asset Shield, and then I'm gonna go through the Income Shield product. Before I do, I want to go through some of when people hear the word annuities, what do they think of? I'm going to go through the different types of annuities. I'm going to go through what is the target market. Where do you source for those clients? And then I'm going to show you really a presentation. I've got two different presentations, and then I have a presentation for FRS as well that you guys could use if you have an FRS client meeting. All right. So just to kind of kick it off, when people hear the word annuities, sometimes there's a sour taste in their mouth, I would say, from the past. What are the few, there's really three, I would say, thoughts that people have when they hear, or sour taste that when they hear the word annuities? What are they thinking of? What does it come from? What are the negatives?
Can't get back your money.
So one negative is that the money is illiquid. So the other thing is that when the person dies, the money at death stays with the company. And then third, good morning. Good morning. Yep. Yeah, so high expenses or high fees. So ladies, we're going through annuities, and we literally just started, but just so because you're sitting down, what I wanted to touch on first is the three things that when people hear the word annuities from a negative perspective that they think of, right, on the negative side, is that the money is illiquid. When I die, my money doesn't go to my beneficiaries. It stays with the company or an insurance company. And then lastly, people believe that the fees internally for the product are high. And we're going to go through the annuity world today, and some of these are not true at all, okay? So there's four different types of annuities out there. What are the four types? So you got single premium immediate annuity, you have fixed, you have variable, and what else? That's MIGA's a fixed annuity. And you have fixed index. Okay. So with a SPIA stands for what? I'm going to go through this quickly. Yep, so a SPIA is single premium immediate annuity. What is this exactly? Lump sum of money. So the client deposits a lump sum of money in one time. So it's a one-time deposit into an account. By the way, before I go any further, the only companies that manufacture annuities are what companies? Insurance companies, right? So they're investment companies don't manufacture annuities. It's only insurance companies. So single premium immediate annuity is client deposits a one-time single payment, and what happens? Income's immediate, right? So single premium immediate annuity, it's saying insurance company, I give you X amount of dollars lump sum. You're going to give me X amount of dollars for the rest of my life. This is, what is this in the public sector? That's it. That's exactly what this is. This is taking private money and making a personalized pension plan. So this is a lump sum deposit. In turn, for the highest income for somebody's life. Are there fees on this account? Don't all jump at once. No fees. There are no fees on this account. Is there market risk? Stock market risk? No. There's no stock market risk. It's basically based on what? Their age. Life expectancy, their age. So the older somebody is, the higher the monthly payment. The younger somebody is, the lower the payment. In this world, I'm not going to go too detailed, but just so you guys have an understanding, really when you're working potentially with people that have pensions and really with people that are employees in the public sector, is that there are a few different ways to take the annuity or to take the annuity payments. So the first way is what's called life only. So this is the person, the client saying, if I give you, call it $500,000, Mr. and Miss Insurance Company, you're going to give me, let's say, $6,000 for the rest of my life every single month. Now, at death, when I die, my spouse and family gets nothing. So it's basically giving me the highest amount of money for the rest of my life, but when I die, there's no money left behind. Okay? So in one of those, remember the three call it pitfalls or belly aches or negative, whatever you want to call it with annuities was at death, company keeps the money. Number 2 is illiquid. And number 3 was fees. Does this have high fees? No. Is it illiquid? Yes. Do they keep my money? Yes. When people think of, call it, I don't want to say negative, but they have that negative taste, this is really where kind of it's stemming from. But this is, it's not bad. This is where the person has, and this is at really retirement when somebody would look at this potentially. So it's life only is that they give a 500, call it, and I'm coming up with whatever math, $500,000 deposit. That client is getting $6,000 a month for the rest of his or her life at death. Insurance company keeps the money. You'll have what's called life with period certain, which means that the person might get $5,800 a month for life, but they're going to guarantee that the $5,800 a month, if the person dies, is going to be paid for 5, 10, 15, or 20 years. So period certain is 5, 10, 15, or 20 years from the time of deposit. So as an example, person might be, let's say, 60 years of age when he or she deposits this $500,000 in. Let's say he's 60. Let's say she's 60, right? She does a 10-year period certain. Let's say she's getting $5,800 a month for the rest of her life. Let's say she's still around at 75. Is she still getting the $5,800 a month? Yes. So remember, as long as she's alive, she's getting $5,800 a month. Whether she's 90, 91, 93 and a half, she's getting $5,800 a month. If she dies and you want to put her on ice and keep the payments going and you figure out a way to do it, right? I'm joking. My point is, as long as the person is alive, payment is coming in. If she, let's say, is 60, deposits $500,000 in a 10-year period certain, and dies at 62, what happens? Family gets paid for a beneficiary. Correct. So the family or the named beneficiary will get paid until age 70, and at age 70, guess what? No more payments. So as long as the person's alive and all of these annuities, payments continue. In period certain, let's say she died at age 71, would there be any payments to the beneficiary? No. So 5-year period certain means for 5 years of guaranteeing payments, for 10 years, 10 years, 15, 15, 20, 20. Okay? Number 3 is going to be joint life. So this is pretty simple. They might give me $4,000 a month while I'm alive for the rest of my life, and I die. Melissa, my wife, gets $4,000 a month for the rest of her life. At her death, when both of us are gone, no more payment. Okay, so this is joint life. So it's literally they're guaranteeing payments for both individuals' lives. Make sense? Nope. It's just as long you have husband and wife or same-sex couple, as long as they're legally married, you've got guaranteed payments for both of their lives. Whether the husband dies first or the wife dies first doesn't really matter. Bottom line is $4,000 is coming into the household for as long as both or one of them is alive. When they're both dead, no more money. The last one that I want to share with you guys is what's called life with cash refund. So this means that let's say they're going to give me, I'm coming up with whatever the number is, $5,000 a month. I put in $500,000, they give me $5,000 a month, which is $60,000 per year. Let's say I die after 2 years. I used how much? 120. How much does the family get? So 500 was deposited. I got 120 in income. 500 less 120 is 380. They get 380 grand. So basically, whatever shekels weren't used on the deposit is what is left behind. So this is not, again, is it completely money left to the insurance company at death? No. It depends on the design. Why I'm going into this with you guys is it's very unlikely you're going to show this or do this for a client. You will if they have a lot of money, or they don't have kids, or whatever the scenario is. But why I want to share with you this is because this is how people will choose their pension options when they go to choose them. So if they work for a company or they work for the public sector and they're about to retire, when they choose their pension option, they're choosing one of these options. And it says it on the pension, on the forms, right? What is the target market for this particular product? I'm going to go one by one on these products so you guys can understand who is the target market. Who? So this is somebody that is target market's going to be is retired and needing income right now. What else? Okay. Yeah. What else? Morning. So it could be money inherited, but again, it's going to be in the main is income. The thing is income now. For whatever reason. Is this person risk taker or risk adverse? They're risk adverse. Somebody with the mentality of I want to set and forget, right? What else? Wins a lawsuit sometimes, don't they? This is exactly what they have to do. Yes, that's exactly what this is. If somebody has a lawsuit, a slip and fall, or whatever type of lawsuit it is, when there's an award given to how do you say it, the defendant or the claimant, it's going to be done with this sort of thing. Right. When somebody wins the lotto, they have option 1, which is, let's say, 30 or 40% of the lump sum. And then option 2, which is a annuity payment, which is exactly what this is. Right. So one of the things, just so you guys can see here, what you see, it says life only. Most people are going to look at this and say, who the hell is going to sign up for that? Right? Why? Because there is a chance that person puts in money, whether it's 100,000, 500,000 today, and immediately tomorrow they die, and then the money goes nowhere. You can take that money, right? And this is how some people use it in the pension world. Is you could do pension maximization where they take life only, but with a certain dollar amount, call it $500 a month of the $6,000 that they're receiving, they can purchase a permanent life insurance policy that upon their passing, spouse or named beneficiary gets a lump sum of tax-free benefit that then they can maximize their income that way. So this is not totally bad. You just need to know how to structure it, right? So this is somebody that wants, again, that's retired, inherits money, but really the main thing is that they want income now. They're risk adverse, and somebody that wants to set and forget. Any questions? This is going to be the least used annuity, but you guys need to know how this works, because this is how, when people again sign up for their pension options, this is what they're deciding.
What are the tax
implications? Same thing. So if you're, meaning when I say same thing, if somebody's depositing pre-tax money, so 401k money, what happens to the income? It's all taxable. If somebody is using after-tax money, the majority of it is tax-free, and there's a small dollar amount that is taxed based on their age. And it will actually say on the illustration what is taxed and what is tax-free. So if it's after-tax money that's invested, the majority of it is tax-free income, and a small portion of it is going to be taxable.
What if none of it was taxed and it's not a 401k, like a settlement, like a personal injury settlement that comes?
It's going to be the same. It would be the same. It would be the same thing where you've got a portion of it's going to be tax-free and a portion of it will be taxed. Same figure. Say it again. Right. Any other questions on this? Nope. Okay. So this was the SPIA single premium immediate annuity. Can I erase that? You guys good? Okay. Fabian, yes? Okay. So guys, the next one, and let me take a step back for a second because Trish sparked my mind, and I assume that everybody knows this, but I shouldn't. Before we talk about an annuity, which we just did, the first thing that we've got to look at is types of money. So when I say types of money, this is how did you tell Uncle Sam you want your money to be taxed? So you either said, I want my money to be is non-qualified, meaning I went to work, I already pay tax on my money, and I'm going to just pay tax on the growth, or a Roth IRA, which there's no tax on the gain and there's no tax on the withdrawal. This is not an annuity. This is retirement plan. And then you've got IRA or traditional IRA, which is also like a 401k or a SEP or a simple. This is you went to work and you got a tax deduction for making the contribution. The money grew tax deferred over time. And when the person goes to retire, they pay tax on how much? All of the money. So this is after tax contributions, and you just pay tax on the gain. The gain is taxed. On a Roth IRA, it's after tax contributions, tax deferred growth, and tax-free income. Why everyone doesn't do this is because there's limitations on what they can earn to fund, and there's limitations as far as what they can contribute per year. It's $6,000 to $7,000 contribution per year based on age. Under 50, over 50. That's as much you could put in there. And then this one, right, which is traditional IRA or 401k or SEP or simple, this is going to be a tax deduction for the contribution, tax deferred growth, and then 100% taxed at retirement. Does that make sense?
That's qualified.
This is qualified. Correct. Right.
But just, I know it's a simple point. Under Roth, you have tax deferred growth. It's not tax deferred. You never pay tax on growth.
Right. I'm just saying it is, yes. But if somebody says how do they in their mind when they say how is the growth taxed, it's tax deferred or tax free, however you want to call it. Right. It's indefinitely deferred. You guys understand these? So this is first and foremost when I invest money, I've got to tell Uncle Sam how do I want my money taxed? From here, a person can invest in anything that they want to invest in. They can invest in CDs, they can invest in money market account, they can invest in savings, they can open up a brokerage account and invest in stocks, bonds, mutual funds. They can invest in an annuity, right? An annuity is one of the options that we're discussing, and inside there's 4 different types of annuities, which is what we just discussed. Okay, make sense on this? So now we went through single premium and immediate annuity. Any one of those tax buckets of money can go into any one of those annuities. How your money is taxed is not dependent upon what annuity contract you go in. There's no way of getting around taxes. However your money's taxed, it's taxed. The next one is a fixed annuity or a MYGA, multi-year guarantee annuity. What is this like? So you've got a CD at a bank, right? So a bank will offer a CD, and the bank will pay, let's say, 3% on the money. In a CD, what happens at the end of every year? Right. So you're gonna pay 1099 or tax on the CD at the end of every single year. And the rates are typically lower than what the MYGA or the fixed annuity rates are paying. So with a MYGA, multi-year guarantee annuity, you can choose from a 2, a 3, a 5, a 7, all the way up to 10 years. I'll show you guys the charts or the graphs. This is, again, done by, or the product is built by an insurance company. The rates right now are 4% and beyond. I'll show you exactly what they are. One of the benefits is that usually the rates are higher than CDs are paying. And a big benefit is you have tax deferred growth on the money. Okay? The only negative is if that somebody needs that money in a lump sum within that period of time, this doesn't make sense for it, right? My point is somebody needs money, like, okay, I have 100 grand and by tomorrow I might call you and say, Jordan, I want to buy a home. Leave it, forget this, just leave it in a savings account, right? Just leave it there. So if the person has a game plan for that pocket of money within the next short period of time, we can't really help them with that pocket of money. Leave it in the savings account. But if you have somebody that has what I call sleepy money, where you've got a lot of people in South Florida that are retirees that just have money piling, just sitting in banks, doing absolutely nothing. And those individuals are risk adverse. They don't want to put the money in the stock market because they're worried about what? Losing the principal. They're worried about the market going down. So they don't have the stomach for the market roller coaster ride. And in this account, is there any risk? So there is no market risk. At death, if I died within that 2 or 3 or 5 year period of time, who gets my money? So at death, my beneficiaries get my money. Are there any account fees here? There's no account fees on the account. And you just have fixed interest for a stated period of time. That's what it is. So
if you are less than 59.5 at the time period is up and you want to take your money,
right,
you pay the 10% penalty as well on the growth
mm-hmm.
or the whole thing.
On the growth. when you pull money out of an annuity, it's always last in, first out. So the interest comes out first, not your deposit. So let me show you guys. To me, the penalty when they're talking about penalties, they're talking about a tax penalty. So if somebody is, let's say, 40 years old and they put $100,000 into a fixed annuity and they take the money out before 59 and a half, let's say it grew to $110,000. Because they had tax, putting it in an annuity, they have tax deferred growth. They should leave it in there in the annuity world till 59 and a half. If they don't, they're penalized on the growth. So that $10,000, they have to pay tax and a 10% penalty. In my opinion, when they're doing their taxes, it's a mood point. It's so little, it's a mood point.
But my question is,
No.
if they put the $100,000 in, they make 10 grand, they pay
The money, the 10 grand comes out first. So they have, in the annuity world, correct. Last in is interest, first out. From a tax point of view, the last money in was the interest, the 10 grand from the company. If I pull money out, even if I pull out 10 grand, in Uncle Sam's eyes, it's 10 grand coming out. I got to pay tax and the 10% penalty. When somebody goes to do their taxes, as I am saying, it's such a, do you guys understand what I'm saying? It's such a nominal amount of money, it's irrelevant.
There's a distinction between first and last. What you're saying, only on from your money, not when it's.
That is correct. That is correct. That is correct. So, guys, as an example, does that make sense? We're not talking about a product penalty. We're not talking about a surrender penalty from the annuity. We're talking about a person saying, I want my money, let's say the 2 or 3 years is up, right? There's no surrender penalty from the insurance company, but they don't want to keep it in an annuity anymore. They want to go buy a house or whatever they want to do with the money. This is what everyone, Trish or Frank and Peter are talking about, for those that don't understand.
Penalty, because the government views annuities as retirement vehicles no matter your age.
Correct.
And that's important to know when talking about a 35-year-old that just sold a house for $1 million and has an extra $500,000 they want to put into something to earn money. If their plan is to pull that money out in 3 years, a MIGA fixed annuity might not be the best solution because of the penalty. So it's just important to know. It might still be the best option.
But they can roll it to another.
Of course. If I move it from a 2-year annuity to another annuity, a fixed indexed annuity or another 5-year annuity or whatever, as long as it goes from annuity to annuity, there is no tax, there is no penalty. And that's it.
So why would someone ever sell the annuity?
What do you mean sell it?
Like, can you sell?
You're confusing selling an annuity income stream, like you're staying up too late and watching commercials at 3 o'clock.
I'm wondering why anyone would ever do that.
Yeah, so it's a good point. That's not this, right? So but it's a good point. So what you're talking about is somebody that had a slip and fall accident or whatever it is, and they have systematic annuity payments coming in, right? So they're getting income, call it 10 grand a month for 30 years. There's a case we have. The guy, this was in New York. The mother was pregnant. This is going back now. The kid's 19 or 20 years old. Mother was pregnant, had some pains or whatever. Went to the hospital. Doctor said, "Go home. You're fine." Make a long story short, had to go back to the hospital. Ended up delivering the baby prematurely because the doctor had malpractice. This kid was disabled. He's got mental challenges, struggles. He doesn't speak the right way. He doesn't have cerebral palsy, but borderline those types of things. sued the hospital, right? Family sued the hospital, and this kid was getting about $20,000 a month from now until 2054. So if you did the math, it was like almost $10 million worth of money. Now that's monthly. Just there's no lump sum, it's monthly. So now the kid is 18, 19, he's getting that monthly payment, but he may want to have a lump sum of money to do something with, to go to school, start a business, or whatever. And I'm giving you an example. So they can either sell all of those payments for a lump sum of money now to have something to do with it, or they could sell part of those payments to have some lump sum and continue money now. They're selling them because they want lump sum money now. That's bottom line what it is. Most of the time, mathematically, I don't want to say it doesn't really make sense, but it's doesn't necessarily make much sense.
So the answer is need.
Right.
It's neat,
Why would
yeah.
someone sell it?
Well, because
Need
they
and
need to.
want.
Because so you're saying you can just pull the money out of the annuity, but that's when you
You're
invest
getting
your own
you're
money.
getting confused with what you have to understand there's different types of. You got a minivan, right? You got a 4-door sedan. You got a sports car. They're all cars. They all drive from point A to point B, but they all have different purposes. And you have a motorcycle, you have a golf cart, you have a quad, you have all different types of vehicles that get you around. My point is, think of them as is exactly what I just said. This is not a payment. Think of this as a place to put money to earn interest on a guaranteed basis with no risk, no fees. Has nothing to do with income payments, has nothing to do with slip and fall accidents, has nothing to do with settlements, has nothing to do with that. Make sense? The other one does. The other one does.
It really has nothing to do with tax
Mm-mm.
or retirement. It's just a safe place to put your money to earn more than the bank's paying.
So guys, this is the most recent as of I think last week when this came in. But anyway, this is the MIGA, right? Multi-year guarantee annuity rates. This is above $100,000 deposit. So you could see these are 2-year bands, 3-year bands, 4-year bands, 5-year bands, 6-year bands, 7-year bands, 8, 9, and 10. That means, to make it simple, somebody puts in $100,000, they're getting 4.25% every year for 2 years. So you put in 100 grand. When you wake up in 2 years, it's worth 108,681, guaranteed. Right? If you look and you say, okay, well, 3 years, it's 4.9%. In 3 years, you got 4.9. In 3 years, it's worth 115,432. No risk, no fees. When that 3 years comes up, you can do whatever you want with it. If you take it out of an annuity, what happens? You pay tax on the 15,432. If you're under 59 and a half, you pay tax and a 10% penalty on the 15,432. If you move it into another annuity, there's no tax, no penalty. You just move the 115,432 into another annuity structure.
And the thing that remember on these, you don't do anything, you're automatically gonna roll over.
Happy birthday.
Thank you.
Same carrier, same term.
Say it again.
If you don't do anything, they're automatically gonna roll over to the
Same carrier.
term, but different.
Correct.
Whatever their current rate is.
Right.
And that's the benefit for doing a shorter period of time, is that if they increase rates and you're locked into a 10-year, you're locked into that rate. If you do a 2-year and they increase, you can roll to a better product.
Yeah, if they go down on that, the 10-year rates are really
Lower.
much
They're
better.
not that much
No.
better
That much
for the
better.
amount of time you're committing to.
No, but somebody
That wants to set it and forget it.
that wants to set it and forget it, or somebody that might believe that, okay, we're going to go through an increased, call it interest rate environment for the next few years. But in 5 years from today, I think they'll start coming down below that they are. This is somebody that's guaranteeing, they want that guarantee out a longer period of time. Now, they could take the interest out every year if they wanted to, penalty free. So if you put in $100,000, right, the interest is credited at the end of the contract year. So you put in $100,000. Let's say we do a 5 year, just to make it simple. It's 5.3%. So 5.3%. At the end of the year, if they want to take out the $5,300, they can. Now, the next year, are they going to have compounded growth on 105,300? No, they're going to have growth on. They're basically getting $5,300 a year. Either you roll it back in and you have compounded interest where the next year it'll be worth 110,881. The following year it'll be worth 116,758. But they do have some bit of liquidity.
Yeah, some bit of access.
Right. But remember, guys, when people retire, right? There was a lady, we had a meeting with her on Friday. She's got, let's say she's got $500K in IRA money. She's going to retire April of 2023. She has Social Security income. She has $500,000 of IRA money, and she's got, call it, $200 in cash. House is paid. Kids are off the payroll. Grandkids are on the kids' payroll. No expenses other than I just want my income when I retire and be able to travel and live my life. Right? So she gets whatever she gets, $2,200 a month from here. She's going to get, call it, another $3,500 a month or so from here, $4,000 a month from there. Her income, the cash flow is good. She said, what should I do with that? Well, do you want to put it into the market? No, I don't want to put it in the market. Why? I'm scared. I don't want to lose it. Right? What is it doing? It's sitting in the bank. What is it earning? Nothing. Put it into a 3-year or a 5-year fixed. Or you could do some in a 2, some in a 3, some in a 5. You could do all of that. But she said, well, what if I need my money? I said, how much do you want to leave on the side? 90 is exactly the number I said. 90? Take 110 or leave 100 and put 100 in that. She goes, what if something happens? I said, if something happens, remember and this is how you have to speak. Remember, your cash flow, you have income, right? Yes. If something happens and you needed money, you have 100,000, you can go to the bank, Wells Fargo, and get it. Can you not? What are you going to do with 100,000? Nothing. I don't have a need for it. So why are you worried about where you're putting 100 grand as far as liquidity? Worst case scenario, if she wanted all of her money, can she get it? Yeah. But so people get worried about the illiquidity, which it's not really. The first thing is there an objective for the money? If the person says, I just sold a house, I want to buy a new house, whether it's 2 months, 6 months, 1 year, 2 years, I want to buy a new property for this pock of money, just leave it in the bank. I don't even want to talk about it. But if their cash flow, meaning income, is good, and they just have shekels sitting there doing nothing, why? Why wouldn't it makes no sense.
Well, and that's what suitability is for too. Because suitability is not going to allow somebody to put all their money
somewhere. Right. So you guys good with this? I mean, yes.
Is there a minimum amount?
There is a minimum amount. The minimum amount that I would tell people is 25 grand, but the minimum amount for some of them is $5,000 to $10,000. But keep in mind, this particular product in commission pays anywhere between 1 to 1.5%, depending on the age, the product, the length of the MIGA. So if you want to complete paperwork for, a $10,000 deposit on a 1% thing, not to sound funny, it's just not worth. Yeah. I mean, the apps are pretty good. It's just You're right.
It's work.
It's work. But it's 5 to 10 grand depending on the carrier. Yeah. Any questions, guys, on this? This is a $100,000 deposit. This is under $100,000 deposit. The only difference is that under $100,000, the rate is a little bit less, right? On a 2-year on under $100,000, sorry, the 2 years 4.25. Here it's 4.1.
Go back.
Right. Questions? Who is this used for? What's the target market? We kind of already went through it, but yep. So you got right over there. So the target market here, again, risk adverse, retiree,
Get the money.
sleepy money. You've got a lot of people that have or are and or have sold properties in the last couple years that for them to buy a new property today typically makes no sense. And certainly from an investment perspective, unless their math is wackadoo, the return doesn't make sense, the net return. So to get a 5.3 or a 5.1 or whatever those rates are, guaranteed return without having to worry about faucets breaking, people not paying rent, eviction notices, and all this other stuff, this is higher than most, call it, investors will receive in rental income in South Florida today, if they're first purchasing a property today down here. Not always, right? But right now it's typically the case. Okay. So these MIGA rates, I could tell you over the last 5 or 6 years, anyone that's been here, we didn't talk about them. I mean, we talked about them, but it was literally, we did nothing with them because guess what? Money was free, right? When all this buildings were going, construction was happening, people were doing this. Why? Because money was free. Today, again, the 30-year fixed mortgage rate is 7%. That's the only reason these returns are the way they are, because money is expensive. So when money is expensive for people to get a loan, for us, it's actually good because we can make people money on their money. So target market, people that are risk adverse, retiree, sleepy money, set it and forget it. People that sold a property recently and just have a chunk of cash that they want to put in there. This is also good, guys, for business owners. That one of the things that we didn't talk about, professionals, business owners, that annuities in the state of Florida, there's 4 things that are creditor protected. One is going to be your homesteaded property. 2 is going to be money in any type of retirement plan, ERISA retirement plan, 401k, things like that. Bucket number 3 is going to be money inside of an annuity. And bucket number 4 is cash value in a life insurance policy. Those 4 things are creditor protected. So you can have people that own businesses. Some businesses might be more litigious than others, that this is a creditor protected bucket and gross tax deferred. Okay, any questions there before we move? No? Yes? Good. There's a big market for this right now, guys. I mean, a huge market. Huge market. I mean, when you guys are just out and about and we're just socializing, the only thing you need to know on this is what are the rates. There's nothing other than that. There's no market risk. There's no account fees. You decide you leave it in there for 2, 3, 4, 5, 6, 7, 10 years, and the rates are going from anywhere from 4.25% to about 5.3% for a 5-year. That's as simple as I can make it. And they could do it with a minimum of $25,000. Less, but 25 grand. Okay. Yeah.
So this is a great product now because of the interest rates on mortgages.
Not Well, because the U.S. Treasury is so high. And it's a two-prong approach, right? So when people go to get a loan from a bank for a car or for a home or for construction, when interest rates are high, it's not a bad thing. Why are Feds increasing rates? Because they're trying to slow inflation, slow the market, right? That's what they're trying to do. It's slowed, but it didn't hit a brick wall quite yet, right? Probably, within the next year. My point is, when that happens, for insurance companies and for what we do, guys, that's a good thing. Just so you understand the mechanics and the math behind it, it is a good thing because we're able to go to somebody and say, guess what? You have 100 grand in the bank account doing nothing. We can get you 2 years is 4.25%, of 5 years 5.3%. I mean, it's that to me is like taking candy from a baby. And separate from that, where it also helps is on the whole life strategies, right? So anybody that's bought a whole life policy in the past, not to make this a whole life class, all of the insurance companies that have and manufacture whole life, they're required to put money in a fixed account and keep it in a fixed account. They're required. And when they keep it in a fixed account, what does it earn? Fixed interest. So over the last 6-7 years, when fixed interest was nothing, what was their money making? Close to nothing. Now fixed interest is 4, 5, 6, whatever that number is that we're going off of. Now their fixed money is earning more money. So just so you understand the mechanics behind it, for our business, it's not a bad thing. And also with the stock market that has dipped 30% or whatever the exact number is. I mean, we had a meeting on Friday evening or late afternoon. The guy lost $310,000 from January to June. 310 grand in the matter of 6 months. Everything is relative, right? Everything is relative. So when people go through that, what are they? They're emotional. People are, right, wrong, or indifferent. People are emotional individuals, and that's what they act off of. Right? All right. So we'll go. So we got that fixed annuity, MIGAs. Okay. Next one. I'm going to go through the next two together. And Peter, I know you've seen this. Frank, I know really you guys have seen this already. The next two I'm going to go through is fixed indexed annuities. I'm going to go through variable annuities. So you guys with a 215, you can market any of these products with the exception of a variable annuity. But I want to explain to you what a variable annuity is, how it works, so that if you find a client that has one, that has lost money in their account and is not that happy about it, if it makes sense for them to move it, what are the options and why? So you've got a fixed indexed annuity, and then you've got variable annuities. So the first thing is we'll look at risk. With a variable annuity, what is the risk that they're taking? So you got unlimited gain potential, unlimited loss potential. With a fixed indexed annuity, what is the risk?
No loss.
There is no market loss. So you're going to the person, come to my casino. You're not going to lose any money. You're guaranteed to have no loss on your money. And there's the potential to gain based on positive index performance, which is why it's called fixed indexed annuity. So no loss potential, but you can gain. Variable annuity, unlimited loss potential, unlimited gain potential. Somebody to say something? Sorry. Both of the accounts can be used for either growth and or income purposes. I'm just going to write it in the middle. Okay. Both of them have what's called a CDSC. So this is a surrender charge of anywhere from 0 to 10 years, 0 to 7 years. This is what's called a surrender penalty. It's client deferred sales charge. Did I say that right? Client deferred sales charge. CDSC is what is the surrender penalty? Now, that's if they want to liquidate all of their money. You guys are going to see this in a second. This is, can they take income immediately if they want to? Yes. Is there a surrender charge if they do that? No. If they want to take their money and run for the hills, that is when the surrender charge is incurred. Make sense? So you've got the risk, you've got growth and income as far as the purpose is concerned. The deferred sales charge is anywhere from 0 to 10 years or 0 to 7 years, depending on the company, the product, the whole thing. Fees. Over here, you don't have to know this, but I think it's good when you do know it because you could speak to it. A person that has a variable annuity, regardless of the company, is going to pay for 3 lined fee items. The first one is going to be what's called a mortality and expense charge, and the fee is going to be 1.25% per year. The next one is going to be a sub-account, or just think of it as a mutual fund charge. Again, that's going to be whatever they're investing in, T. Rowe Price, Fidelity Fund, American Funds, whatever the fund is, they consider it a sub-account, not a mutual fund. Just think of it as a mutual fund, because if you say to the client a sub-account, they're going to say, what? Just say mutual fund, right? Mutual fund. These are going to range, and it depends, anywhere from 0.15 to 1% again per year. And then you'll have what's called optional rider charges, and the rider could be for income and or death benefit that range from 1 to 0.25 per year. So all in, you can be anywhere from 2.5 to 4% per year on a variable annuity. So that means if they are paying, let's say, 3% per year charge, and the market loses 3%, and they had 100,000, what is their value? 94, right? Over here, the fees range anywhere from 0 up to typically 1.15, or sometimes it might be 1.25. It depends on the carrier. Anywhere from 0 to 1.25% a year, all in. So let's say same scenario, right? The person has $100,000 invested. They have an account where they're paying 1.25% a year for a fee. Market lost, so their account didn't grow anything. What is their account value? $98,750. Their account didn't lose value, but the fee still came out. Make sense? Here, the fee came out, and they lost 3% in that example. Their account is now valued at $94,000 if they deposited $100,000. Before I go any further as far as the investment structure on this piece? No? How this money grows on a variable annuity is there's a few options. So if you ever had a 401k and every November you go to pick your options, one of those options is a fixed account, and then there's a bunch of mutual fund options to choose from. That you look at the other person sitting next to you and say, I don't know, what are you doing? What are you doing? They just start Christmas treeing it. All right. Investment options on a variable annuity is a fixed option. And then there's a bunch of separate mutual fund options. You could be small cap, mid cap, large cap, bond, all different types of funds, and they can mix it up. They can do 100% in the fixed or 100% in the funds, and every year they can move it around. Okay? In here, or with a fixed index annuity, there is also a fixed option, Right now, it's usually 3%-ish is what the fixed bucket is paying. And then you'll have, I'm going to share with you guys from a high level how these strategies work, and then I'll show you a few of them. So you'll have what's called a cap rate, S&P 500 of, let's say, the stated cap is 10%, point to point. So if the account was open tomorrow, November 1st, 2022, the company, the insurance company, is going to look at it. What did the index S&P 500 do from November 1st of 22 to November 1st of 23? If the market, if the S&P 500 did 20% return positive, what did the client get credited? 10%. If it did 12%, they made 10%. If it did 8%, they get 8%. If it does negative 10, they get 0. Okay, so the first strategy is a capped strategy. You get up to the stated cap on a contract to contract year, not on a calendar January 1 to 12/31 year. Good? So if you guys understand mechanically how the car works, when you read different annuity structures, you can this might sound foreign right now, but after you see it a few times, I'm telling you, you'll get it. I promise you, right? So it's going to take 5 times. So you got to see this 5 times. The first time you're going to have deer in headlight look. But by time number 5, I mean, like he could probably teach this thing at this point, right? I mean, you're going to, right. Cap rate, okay, and also, guys, IULs operate from a crediting perspective the same way. So if you know how the IUL credits, it's the same thing as an FIA, fixed index annuity, okay? So you got a fixed option, which is just a plain vanilla fixed, which we just went through. You got a cap rate, as an example, S&P 500. You'll have what's called a participation rate, and they'll say point to point, S&P 500, and it might say 50% participation rate. So let's say client opens up the account November 1st, 22 to November 1st, 2023, S&P 500, and the company has a 50% participation rate. I'm moving around to piss Trish off. 50% participation rate. So if it goes up, if the market does 20%, what does the client get? 10. If the market does 30%, what does the client get? If the market does 18%, the client gets 9. If the market does negative 16, client gets. So you get correct. You get to participate in 50% of whatever the performance is, uncapped. So if it does 100%, the client gets 50. And in April of 2020, where if you looked at it from April of 2020 to April of 2021, the market did 49.73%, call it 50%. That was real life return. Client would have gotten 25%. So that is called a participation rate. Some participation rates won't be 50%. Some of them might be 30, some of them might be 40, some of them might be 80, some of them might be 120. So if it's 120% and the market does 10, what does the client get? Okay. The last one is what's called a spread. So spread is, let's say, a spread S&P 500 point to point, and the spread is 4%. So let's say S&P 500 does 10% in the course of a year. What does the client get? 6. Michael has bet games before, so you know that. I'm joking. So if spread you guys get in that's what it is. 20. If it does 20%, client gets 16. If it does 24, client gets 20. If it does negative 24, client gets 0. So the spread is what the client doesn't get and gets everything thereafter. It's the vig that the bookie gets when I don't know how else to say it, but that's what it is. But it is. I mean that's how to. But people understand that, right? People get it, right?
It's the portion the bookie gets when you place a bet. They always get their money. They get their
So how or the juice, right? So a client can do 100% here, or 100% here, or 100% here, or 100% here, or a client could do 25, 25, 25, 25, or they could do 100% here and then move 100% here. They could change it every year. They could change it around. Now a client may say to you guys, hold on a second. You said something like, and I'm going to show you 120%. The client's going to say, how does, if the market does 10, you're going to give me 12, and you're also telling me if the market lost, you're not going to penalize me and I'm not going to see a loss in my account? How does a company do that? What's the response?
I always, I don't know how I'm correct it is, I always say, plus you're giving them the money for a fixed period of time, they know exactly how much they can make off of it, and they can credit you accordingly, they know how much they're going to.
That's part of the answer. What's the other part? That is part of the answer. The other part is how a company hedges their risk is they buy options to offset the risk. That's bottom line where it comes from. But I mean, when you say that, when you say the company has your money for a period of 5, 7 years or whatever the period is, so they can anticipate what their return will be. Separate from that is they buy options to hedge their risk. Those are the two ways that they protect themselves. And most of the time people are like, oh, I got it. Especially the smarter the person, when you say it, they really got it. Okay? So a client that has a variable annuity, just to give, well, we'll get into that in a second. Let me show you some scenarios. Any questions over here, guys, before we go? Because I wanted to give you, first off, before I show you illustrations, I wanted to give you meat and potatoes of how these two products work. How this works, and then when you understand the mechanics of it, then you can build it, make suggestions.
A lot of the investment accounts, out of retirement system, not in the pension plan, are actually very important.
Yes. Yep. Um, so what I want to show you guys, now these accounts can be used for for growth or income or a combination of the two. All right. And when we're doing this, I'm going to show you from a concept level. And then on Thursday, their American Equity is we're doing a training with them on Thursday morning via Zoom. I always tell you guys, to have visuals and have things that you can show clients as an example. It doesn't mean that's going to be theirs, but to get the ball and the conversation going, I always like to have examples or visuals that I'm able to show them. If they understand and like the concept, then I can go to the drawing board and build it for them. So this is what's called an Asset Shield 10. It's with American Equity as the name of the company. And there's a lot of different companies, but they have a pretty strong product. And what this is that it's a 10-year growth product. They also have an Asset Shield 5. What do you think that is? A 5-year. An Asset Shield 7 is a 7-year. And an Asset Shield 10 is a 10-year. When you understand how it works, you're going to understand how they all work. It's just going to be a difference on the crediting that they get. The longer that they leave it there, if it's 10 years, guess what happens? Do you think the interest is higher than the 5-year, and the 7-year is higher than the 5-year, and the 10-year is higher than the 7-year, and so on and so forth. Make sense? So this is a growth strategy. They can use it for income, but it's really, in my opinion, more for growth. In this example, client deposits $500,000. And they're going to, the index is S&P 500 Dividend Aristocrat. So this is the top 25 paying stocks within the S&P 500 that over the last 25 years has consecutively given a dividend or paid a dividend. If they haven't done that, they're not part of this index. Okay?
Actually raise their dividends every year.
Okay. Raised and paid?
Paid and raised.
Okay. So 500,000 is what goes in at age 62, and age in this example is irrelevant. It's just in this example, but on other ones, on income annuities, it is relevant. This one, it's not. 500,000 goes in, and when you guys look at this illustration, you'll see over here, let me make this a little larger. So you see it says this hypothetical illustration depicts how your index credits would have been calculated for this strategy based on the values from January 1st of 2012 through January 1st of 2022. So it's actually showing what their money would have done had they invested in that time frame. All of the annuities do that, okay? So in year one, client puts in $500,000. The S&P 500, the index, let me just say, does 5% return. They're credited 120%. This is a participation rate, and the rate is 120. So if the market did 5, which it did in that year, they're getting 120% of the 5, which is 6%. And they're getting 6% on the 500,000 is $30,000 of interest. Their new account value is $530. Remember, there's no account fee. The following year, the index actually did 12.67%. 120% of 12.67 is 15.21. 15.21 on top of 530 is 80,613. Their new account value is 610.
A point is that I like to emphasize with them is the principal's protected, but any credited interest that next year becomes part of the principal and is protected.
Right. So what you'll see, and we'll get there in two examples. So in year 3, market does 4.1% or 4.81%. 120% of the 4.81 is 5.77. 5.77 times 610 is 35,000 of interest. The new account balance is 645 at the end of year 3. To Frank's point, the following year, the index actually lost in real life 1.5%, right? We're not crediting. Remember, 0 is the bottom line. And you'll notice there's no interest credited. But to Frank's point is the prior year's account balance is carried forward. The following year, the index does a measly 2.31%. 120% that is 2.77. They're credited, again, 17,000 of interest, which is then compounded on top of the 645. It's worth 663. At the end of 10 years, the client has now a $900,000 balance. Can they leave it in there? Sure, this is what it would look like if they left it in there. Could they take half of it out at that point, penalty free? Sure. And every year at the end in this account, at the end of contract anniversary, starting year at the end of year 1, they're able to take out 10% of the contract value penalty free. So at the end of this one, they'd be able to take out 53,000 penalty free. No market risk, no fees. You could participate if the market performs positively. If not, obviously you see real life not beaten up by the market.
But unlike the index universal life insurance policy, if they pull that 10% out, the growth is affected.
Mm-hmm.
And you can't put it back in.
Right. This is.
Well, when you pull out the here, you can't do that.
You could do another annuity, but not to this annuity.
So why would you ever go with the variable annuity if you could just do a participation rate on the fixed one with no loss, 100% of the upside?
The variable may grow.
Depends on your risk.
Depends on the risk tolerance.
Gut
I mean, if
feeling of
you're
what the market's
25
gonna
years
do.
old, I would do a variable over that because you have so many years to build up.
What age would you stop making that recommendation?
Anybody who's thinking about retiring, 50 or above, I would probably encourage more people to start doing this. A portion of it.
And age is one thing. Nearing retirement is part of that, but it's also the stomach or that somebody has for risk. I mean, I've had clients that are young that should be in the market and don't want to do it, right? And I have clients that are older that guess what? They don't care. They don't care, right? The guy that lost the 300 and whatever 10 grand that we spoke with, we had a meeting on Friday evening or late afternoon on. He's aggressive. He wasn't, was he happy it lost? No. Does he think it's going to go back up? Yes. Does he understand at this stage of his life he should be, more, I don't want to say risk adverse, but he should be a little bit more cautious? Yes. But it depends on the client. It really depends on the client.
I had a client who was working for FSU in Switzerland. She was forced to pay into the retirement system. And now she's going back to Switzerland. She wants to do something with the money. She doesn't want to ever have to look at it.
Right.
So we'll put it into an annuity.
Right. So guys, this is a growth product. This is a growth product. It's the way I explain this is you go to the casino, and I've said this a bunch of times. Bellagio says, Peter, I'm going to fly you out to the Bellagio. Come to play craps on my table, right? You put $1,000 down, you're not going to lose the $1,000. You're guaranteed to walk away with at least $1,000, and you're going to have free drinks, right? The account is free, right? If you make money, I'm not going to credit you on all that you make. I'm actually going to give you, for every dollar you earn, I'm giving you 1.2 for every dollar you make in this example. But you have to stay at my casino table for a minimum of 2 hours. If not, we're gonna take some of your $1,000 that you put down. Would you come play? That's basically what I'm metaphorically giving you an example. Say it again.
Some advertisement from some betting app on football where they'll give you $1,000 in free bets.
Right.
So it's like, people do that kind of thing.
Anyway, this is a growth product, guys, right? So there's no fee, there's no risk, and they can participate in a gain when the market goes up. All right, this is one piece of the puzzle. The other one that I want to show you before your heads start really hurting is this is an income annuity. This is also with American Equity, and it's what's called the Income Shield 10. They also have an Income Shield 7. They also have an Income Shield 5. But this is for somebody that says, I have 500 grand and I want income. I don't want income now. I just want income, let's say when I'm 72. Guys, on a guaranteed basis, right? You can see it says here in blue and underlined. Person puts in 500 grand. Age in this example is important. In this particular income annuities, age is important. 500,000 goes in, and guaranteed, come hell or high water, at age 72, he or she is able to take out $68,000, $828, for as long as they're alive. If they want to take less, can they take less? Yes. But the maximum that they're allowed to take out without running out of money, meaning they're saying, as long as you do this, as you give us the 500,000, Mr. Client, Michael, we're going to give you $68,000 for the rest of your life. Now, there is a chance that if you live a long, ripe, healthy life and the account doesn't do anything, as you could see here, this is showing there's no return on the money. Hold on one second. By year number 16, the client has no value left over if the market doesn't do anything. Now, but if he's at 72, he's taking at 68, 68, 68, 68, 68, 68, 68, and at 90 has, let's say, $300,000 left over, what happens? $300,000 goes to a named beneficiary. Okay, but there is a chance that somebody runs out of money because they're taking income and the account doesn't perform positively. If the account hits zero and they're still alive, do they get the 68,000? Yes. That is a key factor that people have to realize, because when we're solving for retirement, what are we solving for? Lifestyle, income, done, period. I don't want to, this guy, he's a client. He's been a client for a long time, very analytical, has a, how do you call it, psychology practice or whatever. He says if I can make $2,000 to $3,000 a month, I'll close my practice and just be good. That's all I want to know. Is I want to make sure that me and my wife make another $2,000 to $3,000 a month in addition to what we have now. What do I need to do? That's where this comes in. He just wants to know that whatever I put in, we're getting the $2,000 to $3,000 a month. Can I solve that way? Can I solve for this is what you need to deposit based on what you want in income, based on your age? Yes. How I like to illustrate this, guys, is very simple. Is that let's say this person, let's say you have a client age 62. He or she has $500,000 in a 401k or traditional IRA. Let's assume that they're going to earn 6% net rate of return over the next 10 years. Fair? That's a gross return of 8%. If they want to change it, I could change it. But let's say they want to do that, right? So they put in $500,000. Remember, they're not paying tax right now on the money. They're not taking income because they're still working. And we're assuming a 6% net rate of return. So in 10 years, at age 72, it'll be worth $895. Starting balance $895, okay? Now, when they do that, they're going to get an income, 4% is $35,000 a year. That is the number that they should take, no more than that out of their account. If they do take more, they're running the risk of running out of money. So the way I like to show this is that you have two scenarios, right? So imagine we've got two options. You have $500,000 of cash, you're age 62, and we're going to assume that it does, again, the 6% net rate of return from now until 72. The value of that account will be $895. Now, I can invest the money for you. You could do it on your own, or you can go to Merrill Lynch. Wherever, as long as you're getting that 6% net rate of return, it's worth $895. Yes? When you go to retire, you've heard of the rule of 4%. You should not take more than 4% of that $895, or $35,000 a year. So if you take $35,000 a year and you live till age 92, you've withdrawn $716,000 from the account. Now we have another scenario, which is again a personalized pension plan, also known as an annuity. You put in $500,000, and for income purposes, in 10 years, you have an income value at just over $1 million. That's not walkaway value, it's income value. When you go to take income that year, they're guaranteeing that you're getting $68,000 a year for the rest of your life, which is a difference of $33,000 a year compared to your brokerage account or IRA or whatever. And over the course of 20 years, from 72 to 92, you've taken out $1.3 million, which is a difference of $660,000. This account, there's absolutely no market risk. You're guaranteed that that is your income at 72. This, is there a possibility that it's worth more than $895? Yes. Is it a possibility that it's worth less? Yes. Is there a possibility that it's worth more and you take more income out and then you run out of money? Yes. This is risk. This is no risk. So some people want to do only this. Some people only want to do this. Some people will say, sign me up, I want to do a little bit of both. I like showing that as a comparison. All I took was the math. That's all I took. What questions do you guys have on this? So this is an income annuity.
What's the difference between the income factor and the annuitizing?
When somebody annuitizes the annuity, they're turning it into SPIA. So at death, there's no money left behind. When somebody takes just that income factor, that $68,000 in this example, if there is money left over, family gets that money. The other difference is that a person doesn't have to take the 68 grand a year. They could take less, or they could take none. It's completely at their discretion. Once you annuitize it, you've got to take that number. Well, if it's I was showing it's pre-tax, but if it's pre-tax money,
Taxes
there's
based
no.
on-
If it's non-qualified, yes, but if it's 401k, then no. Which is the example I was giving this as a 401k example.
So when you're doing an illustration, it's really, it asks you if it's qualified or non-qualified, but really has no impact on the illustration.
No. It does on what you're talking about, which is that income piece, but on the dollar to dollar, it doesn't. So, guys, what questions do you have on this before we're going to end in a minute? Any? None? Okay. So just before we end this and you walk out with a deer in headlight look and you got a headache and all those things, you got to see this, like I said, a few times. If you identify a client that has a need or a want potentially to look at this, just knock on our doors, right? In the beginning, remember, don't try to do it on your own. You'll see it in life, real life action, and it'll make sense. And remember, when we're doing planning for somebody, depending on where they are, if they're about to retire or they're retired, what is the first thing that they're wanting? They want cash flow. That is the first and foremost thing that somebody wants when they're approaching retirement or they're in retirement is, I was going to work to make money. Now I'm not working to make money. I get Social Security. It ain't enough. I'm worried about income, or very simply put, cash flow. Separate from that is I want to make sure I've got money aside that emergency. And then the other thing is I want growth. So when we're solving for income, guess what type of solutions we're using? Which one of these would we use in this example? Which product will we use if we're solving for income? An income annuity, right? An income annuity. If somebody wants for emergency, where should they leave the money? In the bank, checking, savings, money market. Somebody wants growth, what could they do? They could put it in the market, and or they can put it in a MIGA, and or a FIA for growth, the American Equity Asset Shield 5, 7, or 10. Can they do some in here? Some in here, some in here, and some in here? This is typically what a client's portfolio will look like when they retire, not just one. Good? Any questions on that? Nope. All right, where to find these clients, guys? The last thing, where there's, say it again?
That's a good one.
Well, I want to go through two last things. May I erase this? Okay. So there's two last things I want to go through with you guys, and then we'll be done. One is who is the target market, and then last is where to find them. So you got target market and where to source. Who is the target market? We already kind of went through some of this already, but who is the target market? So you've got a retiree. What? Pre-retiree. Risk adverse. Inherited money.
Not a lot of my like they just build a house.
What else?
Lawsuit.
Lawsuit. There's one that's very common. That's not bad. Yeah, divorce is, yep, that's not a bad one. That's, I said what's very common. That's pretty common. Yep. What else? Left a job, right? So if somebody moves from job A to job B, they have an old 401k. What do I do with my 401k? This is a big place to source or, target market.
Does the Income Shield 10 satisfy the government's inherited IRA laws? Now that the new law is you have to dispose of you have to pull all the money out of an inherited IRA within 10 years.
If somebody has an inherited IRA, I don't know if that one does. You want to make sure that the annuity or the account is an inherited IRA account. I don't know on that one if it is.
That's the choice on the paperwork, the application, so you must be able to handle it somehow.
Yeah.
I would think the Income 10.
It should, but I don't want to say it should, because where it may not is if the client is, let's say, 45 or 50, so in there it may not. That's why I don't want to tell you yes or no. Left a job, what else? We talked about it, people that have like sleepy money just at the bank. Where can you source these people from? Where do you find them?
LinkedIn for
So LinkedIn, specifically where on LinkedIn?
announce that new jobs.
So on LinkedIn, when they announce new job, it's what do you do with your old 401k? What else? So LinkedIn. Facebook. People that you know, natural market, referrals, center of influences. A center of influence specifically, if you go to somebody that's just in the Medicare business, Medicare Sup or Medicare Advantage, I've had in the past, when you develop a relationship with those people, the only thing that those agents typically do is Medicare Sup or Medicare Advantage. And not every one of their clients have money, but they don't do what we do even though they have the license to. They can call you from the client's house. The client has, Mary is just retiring. She doesn't know what to do with her money. Right? For those that were here on Friday, Chris is one of the few people that has done a great job at doing both, but most people don't. So if you establish a relationship with somebody, can they get compensated legally on these solutions? Yes, they have the license, right? They can refer it out to you. So Medicare specifically is going to be a big COI, somebody that is a recruiter, right? So let's say you have somebody that's placing nurses, placing physicians, placing IT or accountants, CPAs. What did they do? They just placed somebody from an old job into a new job. It's a referral source. Attorneys where you've got, you could do estate attorneys, you could do divorce attorneys, you could do personal injury attorneys. All those people are going to potentially lead to business. What else? Turning 65 list. People that are turning 65. I've always said, not everyone, but small business, it might be definitely a solution. People that sold their companies, right? So a COI or, people that sold their businesses, that's also another place. That physician that I shared with you on Friday evening that lost the 300 and change, they sold their practice to a hospital. He's going to have more money. He's not going to stop working. He's going to have more money of, what do I do with it? Okay. And one of the last ones, I don't know if you want to put it here or here, there's something called an in-service distribution. So if somebody is presently employed, so let's say you've got, Mary has been working at I don't know, Apple. She's been with Apple for the last 20 years. She's let's say Mary is 60. She wants to retire at 66. Full retirement age for Social Security benefits, as an example. She is still funding. So let's say she has a 401k, and in the 401k, there's $500,000. With the current 401k, she has unlimited gain, unlimited risk potential, and she has fees, but she doesn't know what the return is, and she doesn't know what the income will be from her 401k. Is that a fair statement? She can move all or some of that money into a fixed annuity or a fixed indexed annuity, so an IRA inside one of those two, without any tax and without any penalty. And when she does that, what is she doing? Getting rid of any type of market risk. If she's doing a fixed annuity, she's getting a guaranteed return. If she's doing an income annuity, she's getting a guaranteed income based on the age for the rest of her life. They can do, that's called an in-service distribution. The person is currently employed at that employer. She has no intent to leave there until she's 66. It's, what do I do with my 500? Do I leave it there and roll the dice and hope that the market performs? Or do I shift all of it or some of it to these accounts? Can she move some of it here? Yeah. When she moves it, remember, there is no penalty from the account and there is no market risk. There's no tax when she moves it. You're just eliminating fees as an example and eliminating risk. It's called an in-service distribution. Anyone over the age of 59 and a half that's presently employed can do that. From 50 to 59 and a half, some employers will allow it.
Can't do that in the States.
Right. And there's some, and guys, whenever you're doing this, I mean, most of this is, we're going to call the company with you on the line or with the client on the line to verify that we can do those types of things. But this is very different. Annuities are different than insurance, right? So funding it, some people will think, do I fund an IUL or a whole life, or do I fund an annuity? An annuity is meant for a bag of cash. An IUL or a whole life is to make systematic deposits starting from zero. An annuity is shifting buckets of money around. Could you start an annuity from zero? Yes. I don't recommend it, but you can. Again, annuity is bag of cash to start. 50,000, 25,000, 100,000, 500,000. An IUL or a whole life is I could start from zero and systematically put money in every year. Okay. Any questions on any of this stuff?
What if they're under that age gap in the 40s and whatnot, and they want to do something?
What?
Is there an option of both?
If anybody severs employment, doesn't matter the age, the person could be 23 and do it. So anytime there's a termination of employment, voluntary or involuntarily, they can move the 401k. If they're I'm sorry? An in-service is if they're still employed and they're under 50, they might be able to do it. You just have to call the company that administers the 401k and say, hey, I've got a client. You don't even need the client on the phone for this because you're not asking something specific. You're saying, hey, you're Fidelity, you're the a 401k on ABC company. Do they allow in-service distribution under the age of 50? They're going to say yes or no. If they require, you could just get the client on the phone. But that's a question that they will answer without the client on the phone because it's a broad. I'm not saying how much does Dan have in his account.
That is on the website on the benefits.
Yep. Any other questions? Was this good?
Great.
Bad? So how do you guys walk out of here and get opportunities? When we do this, one is I want to make sure that you understand it. I think you do. I think some of it is foreign for some of you, which is fine, or overwhelming, which is normal. But it's also that you're able to walk out of here, and from here, John comes to mind. Mary comes to mind. Stephanie, these people come to mind. When you call them, guys, don't sell. There's nothing to sell. Hey, I'm new to this business. And if there's someone close to you, you could just be honest with them. Obviously, I entered a new business. I've aligned myself with a great company. In a training class today, things came up that I think that would make sense for you. People are worried about market volatility, meaning stock market going up and going down. A lot of the clients are looking for fixed or fixed income alternatives or fixed growth alternatives. Want you to sit down with one of the experts. One of three things happens. You kick us out. You say, great information, but let's talk in a few months. Or, wow, I didn't know that. Let's do something now. Either which one I'm fine with. I always, at this point, I also like to lead, especially with some of the people maybe that you're in, that you know from the past and stuff like that. Lead with the MIGAs, guys. If you guys can get the door open with, hey, we've got to, anytime I'm on the phone now, if they say no to insurance, as an example, know that insurance is not there, needed or wanted, you have it, whatever. We've got fixed accounts paying 5.3% for 5 years. We've got account 2 years paying 4.25%. No risk, no fees. It's a door. It just gets it going. Any questions? No? Nope. Cool. All right. Thank you, guys.
Thanks, Doug.